Investor who sold their best investment at the worst time. In financial markets, success is not determined only by what you buy, but also by when you sell. Some of the greatest long-term wealth creators in history were not those who found extraordinary assets, but those who held them long enough. One of the most instructive patterns in behavioral finance is this. An investor buys a great asset, endures volatility, then sells right before the biggest growth phase. This paper explores the psychology, historical examples, and structural reasons behind selling the best investment at the worst possible time. 1. The psychological drivers behind premature selling. 1.1 Loss aversion, Daniel Kahneman and Amos Tversky. According to prospect theory, investors feel losses roughly twice as strongly as gains. Even if an investment is fundamentally strong, temporary declines create emotional discomfort that pushes investors to lock in safety. The paradox. They avoid short-term pain, but sacrifice long-term gain. 1.2 Myopic loss aversion. Frequent portfolio checking increases perceived risk. The more often investors look, the more volatility they see, and the more likely they are to sell. This is why daily monitoring increases anxiety. Short-term volatility overrides long-term conviction. Investors mistake normal corrections for structural failure. 1.3 The need for action bias. Humans prefer doing something over doing nothing. In markets, inactivity often feels irresponsible. But in reality, many fortunes were built by sitting still. 2. Historical examples of selling too early. 2.1 Early sellers of Apple Inc. In the late 1990s, Apple was considered a struggling company. Many early shareholders sold during downturns before the iPod revolution, the iPhone launch, the trillion-dollar valuation era. Investors who sold at $10 to $20, split-adjusted, missed exponential compounding. 2.2 Early sellers of Amazon during the dot-com crash. During the 2000 crash, Amazon fell over 90%. Many investors concluded the business model had failed. Yet those who held saw Amazon become one of the most dominant companies in history. The lesson: temporary collapse is not equal to permanent impairment. 2.3 The case of Tesla Incorporated. Tesla experienced extreme volatility between 2013 to 2019. Multiple 30 to 50% drawdowns caused waves of selling. Long-term holders endured ridicule and doubt, but were later rewarded disproportionately. 3. Structural reasons investors sell at the worst time. 3.1 Volatility misinterpretation. Investors confuse volatility with risk, price decline with value destruction. But as value investors, like Warren Buffett repeatedly emphasize, volatility is not the same as risk. 3.2 Social pressure. When everyone around you is selling, holding feels irrational. The discomfort of being alone often overrides rational analysis. 3.3 Short-term metrics versus long-term thesis. Investors abandon strong business fundamentals, durable competitive advantages, long-term growth narratives, because quarterly earnings disappointed. Time horizon mismatch is a silent wealth destroyer. 4. The opportunity cost of selling too early. Selling the best investment prematurely results in loss of compounding, reinvestment risk, emotional regret, tax inefficiency. Most importantly, you rarely buy back at a lower price. Great assets often don't give second chances. 5. Behavioral pattern. The almost genius investor. The most painful outcome in investing is not a bad pick. It is picking the right asset, understanding the thesis, surviving volatility, then exiting before the payoff phase. This creates lifelong regret. 6. How to avoid selling too early. 6.1 Define exit criteria before buying. Sell because your thesis changed, not because price moved. 6.2 Reduce portfolio monitoring. Less screen time equals less emotional noise. 6.3 Study market history. Every great company experienced severe drawdowns, public skepticism, volatile phases. 6.4 Separate volatility from fundamental risk. Ask: is the business deteriorating, or is the price fluctuating? Conclusion: the tragedy of selling the best investment at the wrong time is not about intelligence. It is about psychology. Markets test conviction before they reward it. Often, the difference between average and exceptional results is not stock selection, but emotional endurance. In investing, the hardest part is not finding the winner. It is holding the winner long enough.